Planning to own a property management company? You might want to think twice. Not because you shouldn't do it, it's because there's a real gap between what this looks like from the outside and what it actually costs. And that gap is exactly what this video is for. The pitch sounds almost ideal. No inventory, no equipment, no storefront. You get paid a percentage of rent to handle the headaches landlords don't want. And the industry itself is worth close to $26 billion and still growing. Here's what that pitch leaves out. The advertised fee, usually 8 to 12% of rent, isn't the real cost landlords end up paying. And it isn't the real business you're running either. You're not just collecting a management fee. You're legally responsible for other people's money, under rules strict enough that states have revoked licenses over getting it wrong. So what's the real business hiding underneath that simple percentage? That's what we're figuring out today. One quick note before the numbers start. Every figure in this video is well researched and checked against multiple sources, but research can still contain honest mistakes, and costs and regulations shift by state, city, and sometimes zip code. Treat these as your benchmark, not a quote for your specific situation. This video is for educational purposes only and is not legal, tax, financial, or business advice. Always do your own research and due diligence before making any business decision. A second note, specific to this episode. Trust accounting and real estate licensing rules for property managers vary significantly by state, and enforcement has been tightening. This isn't legal advice. Verify your specific state's requirements directly, ideally with a real estate attorney, before acting on anything here. The first cost, the one that looks deceptively small on paper. Low overhead doesn't mean low stakes. It means the stakes just moved somewhere else. Compared to almost every other business on this channel, property management genuinely is capital light. No inventory to stock, no equipment to buy, no physical storefront required. Many states require a real estate broker's license, or a broker officer attached to the business, before you can legally manage property for other people. That's a real barrier, though a different kind than the capital-heavy buy-ins common elsewhere on this channel. Here's the part that surprises people who assume low overhead means fast profit. By some operator accounts, a portfolio needs to reach somewhere in the range of 250 doors before the business genuinely starts to take off. Below that, leasing fees, renewal fees, and placement fees stay too thin to outrun the fixed cost of running the business properly. That fixed cost isn't marketing or rent. It's compliance, and it's the same whether you manage 20 doors or 300. A management company handling 20 doors still needs the same trust accounting system, the same monthly reconciliation discipline, and often the same software subscription as one handling 300. Scale is what turns that fixed cost from a burden into a rounding error. The hidden trap, the one where you're legally the custodian of money that was never yours. Trust accounting isn't paperwork. It's the actual core competency of this entire business. Every dollar of rent you collect on a client's behalf has to go into a separate trust account, never mixed with your own operating funds. Commingling those two, even by accident, is a real compliance violation, not just sloppy bookkeeping. The timelines are tight. Many states require deposits into that trust account within just a few banking days of collecting them. Every single month, you're required to reconcile 3 separate numbers against each other: the bank statement, your internal books, and the sum of every individual client's ledger. If a management company handles 50 or 100 properties across 30 different owners, each of those owners' money has to stay separately trackable the entire time. This isn't a hypothetical risk. Real estate commissions in states including California, Texas, and Florida treat trust account violations as a top enforcement priority, with real penalties commonly running $1,000 to $25,000 in fines, on top of license revocation for serious cases. One documented case involved a California property management company investigated after pocketing $20,000 in inflated fees, with a $50,000 trust account shortage uncovered once auditors looked closely. That's not a rounding error. That's exactly the kind of failure regulators are actively looking for. Most established management companies run this through dedicated trust accounting software rather than a general bookkeeping tool, precisely because a generalist bookkeeper, unfamiliar with fund separation rules, is exactly how commingling violations happen by accident instead of intent. One more clause is worth reading closely before signing any management agreement, on either side of it. Some contracts charge a management fee on scheduled rent rather than collected rent. That means you could owe, or be owed, a fee on a tenant who never actually paid, which is a very different arrangement than it sounds like on the surface. The real engine, the one hiding behind a single advertised percentage, the management fee, was never the whole business. It's the entry point to 4 or 5 other fees stacked on top of it. So if the headline fee isn't the real number, what is? The national average management fee runs around 8.5% of collected rent. But that's typically just one of 5 to 8 separate fees in a real management agreement. Leasing fees, lease renewal fees, maintenance markup, vacancy fees, and inspection fees all stack on top of it. Add them together, and the true first-year cost to a landlord commonly runs 18 to 20% of gross rent, not the 10% figure most people assume when they hear the headline number. Maintenance markup deserves its own mention here. Many management companies use trusted vendors or in-house maintenance teams, marking up the invoice before passing it to the owner. Handled transparently, that's a legitimate service fee for coordination and quality control. Handled quietly, it's exactly the kind of line item that turns a trusting landlord into a suspicious one the moment they compare notes with another owner. That gap is exactly where a well-run management company earns its margin. Leasing fees, renewal fees, and maintenance markups are where real profit concentrates, not in the monthly percentage alone. Here's a clean, complete example of how one piece of that actually flows. You collect $1,200 in rent into the trust account. You pay a $150 plumber invoice out of that same trust account. Your management fee, 8% of the rent collected, comes to $96, which you transfer to your own operating account. The owner receives what's left, $954, fully documented and reconcilable back to their own ledger. The real money in property management, the percentage on the sign-up sheet, was never the business. The business is the leasing fees, the renewal fees, and the maintenance markup stacked underneath it, run through a trust account precise enough to survive an audit every single month. Put the fee stack and the trust account discipline side by side, and the real shape of this business becomes clear. A landlord comparing management companies by headline percentage alone is comparing the least informative number in the entire agreement. Two companies both advertising 10% can produce dramatically different total costs and dramatically different owner experiences based entirely on what's stacked in the other 4 or 5 line items. From the operator's side, that same stack is the difference between a company stuck below the door count threshold, surviving on a thin monthly percentage, and one that's built real, compounding revenue out of leasing activity and maintenance coordination, on top of a trust accounting system precise enough that a state audit is routine instead of frightening. So let's run the 2 real outcomes. The optimistic case. You build toward that 250 door range with disciplined growth, price the full fee stack transparently instead of hiding behind a low headline percentage, and run trust accounting tight enough that monthly reconciliation is routine, not a scramble. Leasing and renewal fees compound as the portfolio grows. Maintenance coordination becomes a real profit center, and the business becomes genuinely valuable, built on recurring contracts instead of one-off transactions. The realistic case. You stay well under that door count threshold for years, compete purely on the lowest headline percentage to win clients, and treat trust accounting as an afterthought instead of the core discipline it actually is. Thin fixed compliance costs eat a disproportionate share of a small portfolio's revenue. Growth stalls because underpricing left no room to invest in the systems that would have supported it. And a single reconciliation error carries real regulatory risk on top of the thin margin already in place. Same license, same market, same starting fee. The entire gap between those two outcomes comes down to whether the business was built around the full fee stack and real compliance discipline, or around whoever could advertise the lowest headline percentage. So is it worth it? If you're picturing a simple percentage business with low overhead and low stakes, the low overhead part is real. The low stakes part isn't. What's true is that this remains a genuinely accessible, capital-light business with real demand behind it for owners who treat trust accounting as the actual core skill it is, not a compliance checkbox. It rewards a specific kind of discipline that has nothing to do with real estate itself: the willingness to reconcile three numbers against each other every single month, whether the portfolio is small or large. For someone willing to build toward real scale and price the full fee stack honestly, this can become a durable, recurring revenue business with real value behind it. For someone treating the management fee as the whole business and trust accounting as paperwork, the states that have already revoked licenses over exactly that mistake are the clearest warning available. Last reminder: trust accounting and licensing rules for property managers vary by state, and enforcement is tightening. This is not legal advice. If you're structuring a property management business, that guidance should come from a real estate attorney licensed in your state. Remember this: the rent check was never yours the moment it landed in your account. Treat it that way, down to the reconciliation, and the fee stack sitting on top of it becomes a real business instead of a compliance risk waiting to happen.